HIMS has gone from one of the market's hottest healthcare growth stories to one of its most heavily shorted stocks. At one point, the stock exploded from around $13 to $65, giving investors more than a 400% return. Then regulatory pressure, lawsuits, and questions around its weight loss business helped send the stock crashing back toward 15. So what is really going on here? Is HIMS still a disruptive growth story? Or is it just a highly volatile stock driven by headlines? In this video, we will break down why HIMS is so heavily shorted, what the FDA and Novo Nordisk developments mean, how the actual business is performing, what management expects for the future, and what valuation targets currently suggest. Why is HIMS one of the most shorted stocks? Let's start with one of the biggest headlines. HIMS is one of the most shorted stocks in the market, with around 37% of its shares sold short. And that tells us two things immediately. First, a large number of investors are still betting that the stock can go even lower, even after already falling 77% from its peak. Second, it also creates the risk of a short squeeze. That means if even a small piece of good news hits the market, short sellers may rush to buy back shares to close their positions, and that can send the stock sharply higher in a very short time. So this is not a calm stock. This is a battleground stock. It is the kind of stock where sentiment can swing very quickly, and that is exactly why the share price has been so volatile. But why are so many investors betting against it in the first place? According to Reuters, hedge funds have placed very large bets against HIMS. A big reason for that is the company's exposure to the weight loss segment, especially compounded GLP-1 drugs. Here's where the trouble started. HIMS had introduced a low-cost compounded version of Novo Nordisk's Wegovy-related offering, but the FDA quickly signaled that it would take action against what it called illegal copycat drugs. Shortly after that, Novo Nordisk sued HIMS for patent infringement. HIMS pushed back strongly, saying this was big pharma trying to restrict consumer choice. But regardless of the wording, the damage was real. The stock lost roughly a third of its value in less than a week, and the company suddenly looked much riskier in the eyes of the market. Now, to be fair, things later improved when Novo agreed to sell Wegovy and Ozempic through HIMS's platform, which showed that the relationship had partially normalized. But by then, the market had already learned an important lesson. HIMS is extremely sensitive to anything related to the weight loss business. Why the FDA pressure matters so much. And this is the bigger issue. The FDA has made it clear that compounded GLP-1 drugs are coming under tighter pressure as shortages of semaglutide and tirzepatide have eased. Why does that matter? Because compounding becomes easier to justify during a drug shortage. But once the shortage is resolved, those same drugs are considered commercially available, and that means copy compounding faces much stricter legal limits. For HIMS, that weakens the easy version of the GLP-1 growth story. If a large part of the company's weight loss growth was driven by broad access to compounded GLP-1 drugs, then tighter FDA rules create real headwinds. That could mean more regulatory friction, more marketing restrictions, and more disruption to the supply model. And just for quick clarity, compounded drugs are not FDA approved. That means the FDA does not review their safety, effectiveness, or quality before they are sold. The agency has also raised concerns about contamination, incorrect doses, poor labeling, and even hospitalizations linked to some unapproved GLP-1 products. So when investors see a company heavily exposed to this area, they understand why risk has gone up. That is also why, during all this uncertainty, investors have been shorting riskier biotech and telehealth names while moving towards safer healthcare giants like Eli Lilly, Danaher, Johnson & Johnson, Thermo Fisher, and Stryker, all of which have very low short interest. But there is some good news. Now, the story is not all negative. Novo Nordisk has launched a subscription program for Wegovy through telehealth platforms, including LifeMD and HIMS and HERS. That is important because it gives HIMS access to genuine FDA-approved treatment options through a more legitimate and stable channel. Patients can choose subscription plans, longer plans bring lower monthly prices, and Novo is clearly trying to make approved Wegovy more accessible through telehealth. So even though the easy compounding story is getting harder, HIMS may still remain a meaningful player in the weight loss market through more compliant partnerships. And that tells us something very important. The weight loss opportunity may still be real, but the rules of the game are changing. Now let's step away from the headlines and look at the actual business. According to the latest quarterly report, HIMS generated $2.35 billion in revenue in 2025. Net income came in at $128 million, Operating cash flow reached $300 million, and total subscribers climbed to 2.5 million. Monthly revenue per average subscriber reached $83. And that reminds me, if you are finding value in this video so far, and if you like these kinds of business updates, do consider subscribing to the channel. It really helps a lot to grow the channel. Now back to HIMS. The company says HIMS revenue grew more than 30% year over year, while HERS revenue grew more than 100% year over year. Weight loss, men's dermatology, sexual health, and women's dermatology are each now generating more than $100 million in annual revenue, and the HERS brand is approaching the $1 billion mark. And one very important point here, the company says the majority of 2025 revenue came from non-GLP-1 offerings. That matters because it tells us HIMS is not just a one product or one theme company. The weight loss segment may dominate the headlines, but the business itself is broader than that. Now, here's something interesting. Subscribers grew from just 0.3 million in 2020 to 2.5 million in 2025. That works out to a 53% CAGR, which is very strong. But if we only look at the most recent year, subscribers went from 2.2 million to 2.5 million, which is only about 13% annual growth. So yes, subscriber growth has clearly slowed. But then look at revenue. Revenue jumped from about $1.47 billion to $2.35 billion, a growth rate of roughly 59% in 1 year. So how can revenue grow that fast while subscribers only grow 13%? The answer is simple. HIMS is no longer growing just by adding more users. It is also earning much more from each user. Monthly revenue per average subscriber rose 28%, which tells us monetization is improving. Customers are using more services, adopting more specialties, and becoming more valuable over time. That is actually an important sign of business maturity. It means the platform is deepening its relationship with customers instead of only relying on constant subscriber additions. Geographically, the company also remains very US focused. Out of about $2.35 billion in 2025 revenue, more than $2.2 billion came from the United States, while about $134 million came from the rest of the world. That international figure grew almost 400% year over year, so it is still small, but it is moving fast. Now, let's quickly talk about ownership. Founder and CEO Andrew Dudum holds about 10.3% of Class A shares. BlackRock holds around 10.8%, and Capital World Investors holds about 6.5%. Why does that matter? Because it is generally a positive sign when the founder still has meaningful skin in the game. It does not remove risk, but it does mean management remains financially tied to the long-term outcome of the company. Now let's look ahead. For 2026, the company expects revenue of around $2.7 to $2.9 billion, with projected earnings of over $300 million. And by 2030, management is targeting at least $6.5 billion in revenue and at least $1.3 billion in earnings. That implies revenue growth of about 23% CAGR and earnings growth of about 33% CAGR from 2025 to 2030. So when you look at the 2030 target, that is a strong long-term outlook. Now, next year's expected revenue growth is actually lower than the longer-term CAGR target, and that likely reflects the fact that HIMS is investing now for future growth. The company is expanding vertically, internationally, and into new specialties, so management seems to be expecting a stronger payoff in later years, rather than immediately. Another important part of the story is acquisitions. HIMS has said that its 2026 guidance does not include revenue from the planned Eucalyptus acquisition. That is important. Eucalyptus has annual revenue run rate above $450 million, and strategically it could strengthen HIMS's international footprint in Canada, Europe, Australia, and Japan. Then there is Zava, which helps HIMS expand further in Europe. The Canadian acquisition helped launch HIMS and HERS Canada and extend the company's US-style subscription model into that market. And Your Bio is not really about geography, it is more about capability. It supports at-home blood draw and lab testing, which could strengthen diagnostics, personalized care, and treatment monitoring across weight loss, hormonal support, and broader multi-condition care. So when you look at the 2030 target, management is not just talking about growing the current business, it is building a larger, more global, more vertically integrated healthcare platform. Now, before we go into valuation, just a quick disclaimer. This is not financial advice. HIMS is considered disruptive because it is trying to turn healthcare from a slow, fragmented, one-size-fits-all system into a convenient, subscription-based, personalized platform that combines telehealth, labs, AI, and customized treatments. But at the same time, this stock has given investors a roller coaster ride. So what are valuation sites saying what the actual value of the stock is? Alpha Spread shows a base case intrinsic value around $23. Simply Wall Street looks much more optimistic and suggests around $86. MarketBeat gives a 12-month target around $32 with a best case scenario of $68. Stock Analysis sees the stock around $29, and TradingView and MarketWatch are closer to $25 with best case scenarios around $35. That is a very wide range, and that tells you something important. This stock is still highly assumption driven. Because HIMS has such high volatility and a beta around 2.5, it does not look like a stock that calmly trades around fair value. It looks more like a stock that can swing very far above or below intrinsic value depending on sentiment, news flow, and regulation. So this is not really a buy and ignore stock. It is a stock you probably need to monitor closely. And given how volatile it has been, booking some profits during strong rallies can be a sensible approach because sharp pullbacks may create new entry opportunities later. Before we wrap up, let's look quickly at the competitive position. HIMS appears to be ahead of most direct-to-consumer telehealth peers on scale, branding, and category breadth. Based on third-party data, it was roughly twice the size of the next largest U.S. telehealth provider in 2025. Against Ro, the comparison is probably the most relevant. Some industry analysis has described HIMS and Ro as something close to a duopoly in this part of telehealth, although their strategies differ. Ro leaned earlier into manufacturer-linked branded drug channels like Lilly Direct. HIMS leaned harder into cash pay convenience, brand marketing, and for a time compounded GLP-1 access. And compared with where it was in 2021, HIMS has clearly grown a lot faster in terms of both sales and customers, which does suggest that the company has built a stronger consumer-facing platform than many of its peers. So what is the final takeaway? HIMS is clearly a real business. It is growing fast, monetizing better, expanding into new specialties, and trying to build a broader healthcare platform. But it is also a stock that is heavily tied to headlines, especially around the weight loss segment. That is why it can be both exciting and dangerous at the same time. If the company succeeds in turning its weight loss momentum into a more stable, compliant, diversified growth engine, the upside could remain meaningful. But if regulatory pressure, legal disputes, or business model disruptions continue, the stock may remain extremely volatile. So this is not a sleepy healthcare giant. It is a fast-moving, high-risk, high-opportunity growth story. Do give a like if you found this useful, and see you in the next one.